Hi everyone. My name is Brian, so how are you today? I hope you're feeling peachy because we're going to talk about cryptocurrencies today. Are you ready? Come on guys, you need to know about that. It's important, man. Come on guys. Sit down properly and fasten your seatbelt because we're about to take off. I've received 25 questions and I'll be able to answer them. You're all set, so let's get started. Question 1. Why are Bitcoin and Ethereum considered the most important cryptocurrencies? Bitcoin and Ethereum are pivotal because they introduced concepts that radically changed the financial landscape. Bitcoin was the first decentralized cryptocurrency, creating a peer-to-peer payment system that operates without a central authority. It's often referred to as digital gold due to its scarcity and store of value properties. On the other hand, Ethereum is significant because it introduced smart contracts, which are self-executing contracts with the terms directly written into code. This allows for decentralized applications, dApps, to be built on its platform, vastly expanding blockchain's functionalities beyond just currency. Question 2. Can you explain what makes Bitcoin unique compared to traditional currencies? Bitcoin operates on a decentralized network, meaning it isn't controlled by any government or financial institution. Traditional currencies are dependent on centralized entities, which can be influenced by political factors or economic policies. Bitcoin, however, is governed by a consensus protocol among its users, ensuring transparency and fairness. Additionally, Bitcoin's finite supply, capped at 21 million coins, creates scarcity, similar to precious metals, which can potentially increase its value over time. Question 3. What is Ethereum's role in the growth of the cryptocurrency landscape? Ethereum has played a crucial role as it's the underlying platform for countless innovative projects. By enabling smart contracts, Ethereum revolutionized how transactions and agreements are made in a trustless environment, without needing intermediaries, which can be costly and time-consuming. This feature has spawned the growth of decentralized finance, DeFi, non-fungible tokens, NFTs, and a wide array of decentralized applications that are reshaping industries ranging from finance to art and gaming. Question 4. How do the underlying technologies of Bitcoin and Ethereum differ? The primary difference lies in their use cases and consensus mechanisms. Bitcoin uses a proof-of-work, PoW mechanism for validating transactions, which requires significant computational power and energy. It focuses primarily on security and stability as a digital currency. In contrast, Ethereum is transitioning to a proof-of-stake, PoS, model with Ethereum 2.0 to enhance scalability and energy efficiency. PoS allows participants to validate transactions based on the number of coins they hold and are willing to stake, reducing environmental impact while increasing transaction speeds and lower costs. Question 5. Why has Bitcoin attracted institutional investors? Bitcoin has increasingly been seen as a hedge against inflation and economic uncertainty, particularly in light of expansive monetary policies adopted by governments globally. Institutional investors view Bitcoin as a new asset class, akin to gold, due to its scarcity and potential for appreciation. Moreover, the infrastructure supporting Bitcoin, such as regulated exchanges and custodial services, has matured, making it more accessible and appealing for institutional investment. Question 6. What challenges do Bitcoin and Ethereum face in the future? Both face significant challenges. Bitcoin grapples with regulatory scrutiny as governments seek to establish frameworks for crypto assets. Environmental concerns regarding its energy consumption are also pressing, prompting discussions about sustainability. Ethereum, meanwhile, needs to successfully implement its transition to PoS and scale its network while maintaining security and decentralization. Additionally, both cryptocurrencies compete with an ever-growing list of altcoins and potential new protocols that can offer similar benefits or have unique features. Question 7. How does the community around Bitcoin and Ethereum contribute to their importance? The communities behind these cryptocurrencies are crucial. Both have passionate advocates who contribute to their development and adoption. This decentralized aspect of their community-driven governance fosters innovation and resilience. Furthermore, community support plays a role in promoting educational initiatives, advocating for regulatory clarity, and introducing new ideas that can help grow the broader blockchain ecosystem. Question 8. In what ways can Bitcoin and Ethereum influence the global financial system? They have the potential to disrupt traditional financial systems significantly. Bitcoin could promote financial inclusion by providing unbanked populations with access to financial services. Ethereum's smart contracts could automate and streamline numerous processes across industries, leading to increased efficiency and reduced costs. This can fundamentally change how we perceive value exchange, ownership, and even identity verification in a digital economy. Question 9. With so many cryptocurrencies available, why should investors focus on Bitcoin and Ethereum? Bitcoin and Ethereum are the pioneers of the cryptocurrency space and have established themselves as leaders. Their first-mover advantage, combined with robust ecosystems and community support, creates a level of trust and security that many altcoins lack. Additionally, they both have high liquidity, which is a key consideration for investors. The market recognizes their intrinsic value and potential for long-term growth, which makes them relatively safer investments compared to newer or less established cryptocurrencies. Question 10. How important is security in the cryptocurrency space, and how do Bitcoin and Ethereum address this? Security is paramount in cryptocurrency, given the risks of hacks and scams. Bitcoin has proven its security through years of successful operation and has a robust network with a high hash rate, making it difficult to compromise. Ethereum is also focused on security, continuously evolving its protocol. The community actively engages in audits and employs bounty programs to identify and fix vulnerabilities. Security measures such as cold wallets and multi-signature transactions are also widely adopted to help safeguard assets. Question 11. What opportunities do you see for innovation in Bitcoin and Ethereum going forward? Innovation is abundant in the crypto space. For Bitcoin, the potential for integrating Layer 2 solutions like the Lightning Network aims to enhance scalability and speed for transactions, making it more viable for everyday use. For Ethereum, the emergence of new protocols built on its blockchain can further extend its capabilities. Additionally, innovations in governance models, privacy, and interoperability with other blockchains will likely shape how these cryptocurrencies evolve and adapt over time. Question 12. What is the potential impact of government regulations on Bitcoin and Ethereum? Government regulation can have both positive and negative impacts. On the one hand, clear regulations can foster confidence among investors, leading to greater adoption. However, overly restrictive regulations could stifle innovation or limit access. The key will be finding a balance that protects consumers while allowing for growth in the cryptocurrency sector. Open dialogue between industry leaders and regulators will be essential in shaping a framework that supports both interests. Question 13. Can you discuss the social and economic implications of widespread cryptocurrency adoption? Widespread adoption of cryptocurrencies could lead to greater financial empowerment by giving individuals more control over their assets. It can promote financial inclusion, especially in underbanked regions, allowing people to access services that traditional banking often excludes. Economically, it could lead to shifts in monetary policy, as central banks may have to adapt to the reality of digital currencies. This shift could disrupt traditional supply chains and payment systems, leading to more equitable economic structures. Question 14. How do you think the future of Bitcoin and Ethereum will unfold? I believe we will see more institutional adoption for both Bitcoin and Ethereum, elevating their status as reliable assets. As technologies like Ethereum 2.0 come into play, Ethereum may solidify its position as the leading platform for decentralized applications. However, the landscape will be dynamic, with ongoing developments that could bring about both opportunities and challenges. It will be essential for investors and users to remain informed and adaptable as these changes unfold. Question 15. How does the concept of scarcity in Bitcoin contribute to its value proposition as a digital asset in comparison to fiat currencies? The concept of scarcity in Bitcoin is fundamentally tied to its capped supply, which is pre-programmed into its code to ensure that only 21 million coins can ever be mined. This creates an intrinsic rarity that is absent in fiat currencies, which can be printed ad infinitum by central banks. In an inflationary environment where traditional currencies can lose value due to excessive supply, Bitcoin presents an appealing contrast as a deflationary asset. The scarcity function capitalizes on the economic principles of supply and demand, positioning Bitcoin as a store of value akin to precious metals. Investors are drawn to Bitcoin not just as a medium of exchange, but also as a hedge against inflation and currency devaluation, thereby reinforcing its price over time as demand continues to increase with limited supply. Question 16. Can you explain the differences between proof of work and proof of stake, particularly in the context of Bitcoin and Ethereum, and how these mechanisms affect security and scalability? Proof of work, POW, is the consensus mechanism originally employed by Bitcoin and is used to secure the network through computational power. Miners compete to solve complex mathematical puzzles, and the first to succeed adds a new block to the blockchain and is rewarded with newly minted Bitcoin and transaction fees. This mechanism ensures security through decentralization, as a network of miners protects against attacks by requiring substantial computational resources. However, it comes with scalability issues and environmental concerns due to significant energy consumption. Ethereum, initially using POW, is transitioning to a proof-of-stake (POS) model with Ethereum 2.0. In POS, validators are chosen to create new blocks based on the number of coins they hold and are willing to stake, drastically reducing energy requirements. Although POS increases scalability, allowing for faster transaction times and lower costs, it also introduces different security considerations. The risk of centralization arises if a few validators hold a significant amount of the assets, potentially undermining the network's decentralization. Ultimately, while POW emphasizes proven security through labor, POS aims to balance security and scalability, potentially making Ethereum a more adaptable network in the long run. Question 17. How do smart contracts on Ethereum revolutionize traditional notions of trust and enforcement in commercial agreements? Smart contracts on the Ethereum network represent a paradigm shift in the execution and enforcement of contracts. Unlike traditional contracts, which rely on legal frameworks and intermediaries, such as attorneys or notaries, for enforcement, smart contracts self-execute when predefined conditions are met. This automation reduces the reliance on trust in third parties, as the contract operates on a decentralized blockchain, where all participants can verify the code and the transactions it executes. For instance, in a real estate transaction involving a smart contract, once both parties fulfill their obligations, such as payment and property transfer, the contract autonomously facilitates the transfer of ownership and funds without the need for traditional escrow services. This not only streamlines processes, enhancing efficiency and reducing costs, but also minimizes the risks of fraud and disputes commonly associated with traditional agreements. However, the reliance on code necessitates rigorous auditing and testing to prevent vulnerabilities and ensure that the smart contract performs reliably under a diverse range of conditions. Question 18. Considering the fluctuating nature of cryptocurrency markets, how can Bitcoin and Ethereum serve as suitable hedges against traditional market volatility? Both Bitcoin and Ethereum can potentially serve as hedges against traditional market volatility due to their correlation, or lack thereof, with conventional asset classes like stocks and bonds. Historically, Bitcoin has shown a degree of independence from traditional financial markets, meaning that during market downturns, investors may flock to Bitcoin as a safe haven, similar to how they would gold. This behavior stems from Bitcoin's deflationary nature, its limited supply, and growing mainstream acceptance as a legitimate asset class. Ethereum, while more volatile than Bitcoin due to its diverse applications and a more nascent ecosystem, also offers unique opportunities for hedging. The emergence of decentralized finance, DeFi, on the Ethereum network allows users to create financial products that can mitigate risk, such as synthetic assets or crypto derivatives. By diversifying portfolios to include cryptocurrencies like Bitcoin and Ethereum, investors can achieve an alternative asset class that may respond differently to economic pressures and inflationary trends, thereby enhancing their overall risk-adjusted returns. Question 19. What role does the Lightning Network play in enhancing Bitcoin's transactional efficiency, and how does it address current limitations of the Bitcoin network? The Lightning Network is a Layer 2 scaling solution designed to enhance Bitcoin's transactional efficiency by enabling off-chain transactions. It allows users to create channels between two parties, where multiple transactions can occur without needing to be recorded on the Bitcoin blockchain immediately. By settling the final balances on-chain only after the transaction channel is closed, the Lightning Network significantly reduces congestion, minimizes transaction fees, and speeds up processing times. This addresses some of Bitcoin's current limitations, such as slow transaction speeds during peak usage and high fees. The Lightning Network effectively allows Bitcoin to serve as a viable medium of exchange for everyday transactions, enabling microtransactions and facilitating rapid payments, making it more competitive against traditional payment systems. However, the technology does introduce complexities related to privacy and liquidity, and its wider adoption will require robust infrastructure and user education. Question 20. How does Ethereum's transition to Ethereum 2.0 aim to address concerns about its current scalability issues, and what are the anticipated implications for its network performance? Ethereum 2.0 represents a significant overhaul of the Ethereum network's architecture, primarily addressing scalability concerns through the transition from proof-of-work to proof-of-stake and the introduction of shard chains. Sharding divides the Ethereum blockchain into smaller, more manageable pieces known as shards, allowing the network to process transactions in parallel rather than sequentially, thus drastically increasing throughput. The anticipated implications of these changes are profound. With a well-implemented Ethereum 2.0, the network is expected to handle thousands of transactions per second compared to its current capacity of around 15 to 30. This scalability will enhance user experience, reduce gas fees, and enable dApps to function seamlessly even as they grow in popularity and complexity. Furthermore, the shift to POS is designed to improve security by encouraging users to stake their Ether, thus aligning economic incentives within the network. However, the successful implementation of Ethereum 2.0 hinges on the community's support and technical execution to ensure a smooth transition without disruption. Question 21. In what ways does the regulatory landscape for Bitcoin and Ethereum differ globally, and how does this affect their adoption and usage? The regulatory landscape for Bitcoin and Ethereum varies dramatically across the globe, significantly impacting their adoption and usage. In some countries, such as El Salvador, Bitcoin has been recognized as legal tender, which has prompted widespread adoption and integration into the economy. Conversely, in nations like China, strict regulations and outright bans on cryptocurrency trading and mining activities have stifled usage and innovation within those regions. In many Western nations, regulatory bodies have taken a more balanced approach, acknowledging the potential of cryptocurrencies while establishing compliance requirements aimed at preventing fraud, money laundering, and consumer protection. The ambiguity surrounding regulations can create hesitancy among businesses and investors, leading to delayed adoption, especially in industries that are particularly risk-averse. This disparity means that projects built on Bitcoin and Ethereum may have to adapt to local regulatory frameworks, which can influence their trajectory and global reach. Additionally, regulatory clarity in supportive jurisdictions can catalyze innovation, attract investment, and unlock new business models that could drive further integration of blockchain technology into existing systems. Question 23. What implications does the advent of central bank digital currencies, CBDCs, have for Bitcoin and Ethereum, particularly concerning their market positions and user adoption? The emergence of central bank digital currencies, CBDCs, introduces a complex dynamic in the cryptocurrency landscape, particularly for Bitcoin and Ethereum. CBDCs are digital forms of fiat currency issued by central banks, designed to enhance transaction efficiency, reduce costs, and improve monetary policy implementation. While they offer the benefits of digital currencies, their centralized nature contrasts sharply with the decentralized principles underlying Bitcoin and Ethereum. The impact on Bitcoin and Ethereum's market positions will depend largely on public perception and the intended use cases of CBDCs. If CBDCs gain widespread acceptance as a medium of exchange, they could potentially overshadow cryptocurrencies in everyday transactions, leading to reduced adoption of Bitcoin as a transactional currency. However, Bitcoin's unique attributes as a scarce, decentralized asset could still position it favorably as a digital gold for investment purposes, especially in contrast to the inflationary nature of CBDCs. Furthermore, the introduction of CBDCs may lead to increased scrutiny and regulation of existing cryptocurrencies, which could either hinder or accelerate their mainstream adoption. As governments and institutions seek to understand and integrate cryptocurrency technologies, sustained innovation and community engagement will be vital for Bitcoin and Ethereum to maintain relevance and adaptability in an evolving financial system. Question 24. Reflecting on the evolution of Bitcoin and Ethereum, what do you foresee as the next significant developments that could shape their future trajectories? As we look toward the future, several significant developments could impact the trajectories of Bitcoin and Ethereum. For Bitcoin, the evolution of the Lightning Network will be critical. Enhancing the network's scalability and efficiency is vital for its adoption as a common medium of exchange. Additionally, the interplay of global economic uncertainties and inflationary pressures may increase institutional interest, propelling Bitcoin's status as a store of value. For Ethereum, the rollout of Ethereum 2.0 will be a game-changer as it improves scalability, energy efficiency, and user experience. As DeFi continues to expand, we may see regulations emerging to ensure security and protect users, which could stabilize the ecosystem while legitimizing it further. Furthermore, bridges connecting Ethereum with other blockchain networks could enhance interoperability and innovation, allowing for a more interconnected cryptocurrency landscape. Overall, continued advancements in technology, regulation, and user adoption will be critical in shaping the future of both Bitcoin and Ethereum. Collaboration between developers, regulators, and the broader community will be essential in navigating potential challenges while maximizing the innovative potential of these groundbreaking platforms. Question 25. What are the implications of the Bitcoin halving events on its economic ecosystem, and how do these events potentially influence market behavior, price volatility, and miner incentives? Bitcoin halving events are critical moments within the Bitcoin economic ecosystem. They occur approximately every 4 years or every 210,000 blocks, reducing the block reward that miners receive by 50%. The latest halving took place in May 2020, cutting the mining reward from 12.5 BTC to 6.25 BTC. This mechanism is embedded in Bitcoin's code to introduce scarcity, akin to precious metals, influencing both supply and demand dynamics within the market. From an economic standpoint, halving events are generally associated with bullish market behavior. The rationale is that, since the supply of newly minted Bitcoin is halved, if the demand remains constant or increases, the price is expected to appreciate. Historical patterns support this notion. After prior halvings in 2012 and 2016, Bitcoin experienced significant price increases over the subsequent months and years. However, the correlation between halving events and price is not deterministic, and several other market factors, including macroeconomic conditions, regulatory developments, and investor sentiment, can exacerbate volatility. Additionally, halvings alter miner incentives significantly. As the block reward decreases, miners must operate efficiently to maintain profitability, often competing on technological advancements and energy costs. As mining rewards dwindle, miners may seek higher transaction fees to compensate for their reduced block rewards. This can create an environment where less efficient miners are pushed out of the ecosystem, potentially leading to a more decentralized and resilient mining structure over the long haul. However, this transition can contribute to short-term network instability, especially if large mining operations dominate the market due to economies of scale. In summary, Bitcoin halving events are crucial turning points that reshape the economic landscape of Bitcoin. They serve as a mechanism to tighten supply while simultaneously prompting discussions about miner incentives and market behavior, ultimately influencing the asset's volatility and long-term value proposition. Question 26. How do Ethereum's upcoming upgrades, particularly Ethereum 2.0, reshape the competitive landscape with other blockchain platforms, and what potential challenges could arise from these transitions? Ethereum 2.0 represents a monumental upgrade to the existing Ethereum network that aims to address essential issues including scalability, security, and sustainability. The shift from a proof-of-work (POW) to a proof-of-stake (POS) consensus mechanism is the cornerstone of this transition. By enabling users to validate transactions based on the amount of Ether they hold and are willing to stake, Ethereum 2.0 seeks to create a more inclusive environment while drastically reducing energy consumption compared to the POW model. In terms of competitiveness, Ethereum 2.0 is poised to strengthen Ethereum's position against other popular platforms such as Binance Smart Chain, BSC, Cardano, and Solana. As the DeFi and NFT ecosystems burgeon on Ethereum, the successful implementation of scalable solutions, like shard chains, could solidify its status as the go-to platform for developers seeking to build and deploy dApps. Enhanced throughput and decreased transaction costs are critical components that could lead to increased user adoption and retention, further differentiating Ethereum from its competition. However, several potential challenges accompany these upgrades. The transition to Ethereum 2.0 is complex and may introduce unforeseen vulnerabilities, especially during the early phases of implementation. The risk of bugs or exploits within the POS framework could undermine user confidence and jeopardize the network's integrity. Moreover, the migration from POW to POS raises active discussions within the community regarding decentralization. If a handful of entities control a significant amount of Ether, it could lead to centralization issues and threaten the ethos of Ethereum as a decentralized platform. Additionally, the presence of numerous competing blockchains, each with unique features and ecosystems, means that Ethereum must continually innovate to retain its developer and user base. The ongoing journey toward Ethereum 2.0 must address not only technical constraints but also community sentiments and expectations to ensure that it does not lose relevance in a fast-evolving landscape. In conclusion, Ethereum 2.0 heralds revolutionary changes with substantial implications for its competitive landscape. While the upgrade aims to enhance scalability and sustainability, the transition must be managed meticulously to mitigate challenges and maintain trust within the Ethereum community. The outcomes of these changes will influence Ethereum's ability to sustain its leading position in the decentralized ecosystem amid growing competition. That's all for today. I hope you've learned a lot today about today's theme. We'll meet up again some other time. Cheers.